All right, in this lesson, we're going to look at early retirement of bonds. So in the last lesson, we looked at what the journal entry would be if the bonds matured at their maturity date or they are paid off at the maturity date. In this lesson, we're going to look at what would happen if they are if we paid them off before that maturity date, which can happen. We can either have callable bonds in which we say that at certain price or at certain times we can call back the bond, or we might go in the bond market, and if we see it that it's cheap enough, we might decide to buy the bonds ourselves from the market, and now we own our own bonds so we can retire those. So there's a lot of reasons why companies will retire a bond early. Maybe they have additional cash, so they don't want to pay any more interest, so they can go ahead and retire them. So there's a lot of provisions and rules when it comes to early maturity or early retirement of bonds, but this is how we would deal with them from a journal entry from a financial standpoint. So let's take a look here. Companies do not have to wait until full maturity for bonds to be retired. They can usually be retired at any time before the maturity date, as long as the bond agreement allows for it. So if it has a callable action, then they can. They may be able to do it some other ways, but if it says that they cannot be recalled, then they can't. Okay, so as long as the bond agreement allows for it, they can be matured early or paid off early. Now, there are 3 steps to the retirement of a bond early. The first step is we're going to pay the cash associated with the early retirement. The second thing is we're going to eliminate the bond from our books. And then the last thing is we're going to figure out the difference between the two, which will result in a gain or loss. Now, depending on when interest was paid, that's a separate story. So we're not really talking about interest here. We're just talking about the actual repayment of the bond. So if you're thinking about what about interest, we won't necessarily worry about interest unless we have to pay it. And oftentimes if we recall a bond, we may not have to pay it because we just paid the interest very recently. So let's take a look here at an example. Assume company A pays their entire $100,000 4.5% 10-year bond 4 years early due to the increasing interest rate or decreasing interest rate. The company is able to retire them today at a rate of 103. What is the journal entry related to the early retirement of the bond? So what's happening here is that the interest rate is decreasing below 4.5%. So the company doesn't want to have to pay 4.5%. So instead, they're deciding that they want to recall them. They want to pay the bonds off so that they're not exposed to 4.5%. Maybe they're going to rebuy them at 4.5% and issue a new bond at a lower rate, like 2%, let's say. So that's what we're doing here. So we need to calculate how much cash they're going to have to come up with just to retire these bonds. Well, they were sold at 103 right now. So we're going to take the bonds pricing, which is $100,000. Now, since we don't know how many bonds they issued or the issue price of each bond, we can assume it's 100 bonds at $1,000. All we need to do is we'll take the amount $100,000, multiply that by 103 over 100. And when we do that, we'll get $103,000. So what the company can do is they can go pay $103,000 and that will retire their bond. So if that's how much cash they're going to come out with, we're going to credit cash in the amount of 103. And then we also have to get rid of their bonds. So we're going to debit bonds payable in the amount of $100,000. And now the question is, what do we do with that $3,000? We know that $3,000 is going to be a debit in order to make sure our debits equal our credits. And we are going to debit loss on bond retirement, because that's what we're doing here. So it would be a loss. It would be a $3,000 loss. But again, the reason why they're doing it is because the interest rate in the market is decreasing. So they believe that they can get a better interest rate, which will save them more than $3,000 over time. And again, I'm making that assumption because it does say that the decreasing interest rate is one of the reasons why they are retiring them early. All right, so let's look at an example in which maybe the opposite happens. Okay, so assume company A pays their entire $100,000 4.5% 10-year bond early 4 years early due to the market value of their bonds. So their bonds market value went down. So the company thinks, hey, let's go ahead and just buy them back now since the market value has gone down on our bonds for whatever reason. The company is able to retire them today at a rate of 96.4. So they're actually going to be able to retire them at less than their face value. What is the journal entry related to the early retirement of the bond? So we're going to do the same thing as we did in the last example here. We're going to take 100,000, multiply it by 96.4 and divide it by 100, and we're going to get $96,400. Not a bad deal at all. So we know that cash is going to have to leave their hands of 96.4, so we're going to credit cash. We also know that we need to retire the bonds, so debit bonds payable in the amount of $100,000. And then the difference, so in this case, $3,600 would go, instead of a loss on bond retirement, it would be a gain on bond retirement. So gain on bond retirement. And what we're saying here is that because they are cheaper than what we issued them for, we might as well just retire them now at $96,400 because we're basically going to save $3,600. So even though they're not actually receiving gain, they're not receiving $3,600. It's just that they're not paying that $3,600, so it becomes a gain on their books. And again, smart move here. It may be a smart move for them because they are saving $3,600, and maybe that the interest rates are don't even matter in this point. So that's how we would report an early retirement of a bond in which we retire them at less than they're actually worth from face value. So that's what we would do there. Now, what about discounts and premiums? Well, if a bond was issued at a discount or premium, then those accounts would need to be closed as well, and the difference either reducing or increasing the bond's gain or losses. So we would offset that bond's premium or discount by either a gain or loss. So just kind of doing the opposite there. So that is a look at early retirement of bonds. Hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and I'll take you to that video. So until then, we'll see you in the next lesson.